Okay, so we're wrapping up chapter 6 with a couple of um, simple concepts, really. One is looking at inventory on the balance sheet, um, and we're going to do some financial analysis. Okay. So as you know, the inventory account, whether it's called inventory or merchandise inventory, whatever a company decides to go with the formal title of that account, it's an asset, and specifically it's a current asset because they are hoping to sell that inventory very, very soon. So it's going to appear on the balance sheet. Um, okay. And you understand too that another thing that you learn in this chapter was you were introduced in the last two chapters, you were introduced to an expense account that doesn't use the word expense in it. So it's tricky, right? Cost of goods sold is an expense account, which means that it's on the income statement. What the income statement and the balance sheet and the entire report has to disclose is obviously what we do. What's the cost method the company used to get to the value on the balance sheet and to get to the value of cost of goods sold? So they have to disclose whether they use FIFO, LIFO, average cost, or in a few rare cases, there'll be specific identification. But they also have to disclose something called the basis of accounting, which means the number that you see, particularly for the asset, the number that you see, is that the real cost of the inventory to the company? Or did they use a method called lower cost to market, which we're going to look at today? Okay, it's actually quite, it sounds like it's a little bit complex, but it really is quite simple. Oh, by the way, this is, you'll see these are in the notes for, in this, for every public company, they will have to have notes. So here you look at Walmart, and I don't know it doesn't really matter. In this case here, what year it is, they actually use LIFO, okay, for all of the US segment. Okay, so everything in Walmart US, when they come up with their cost of goods sold and the value of their inventory, they're using the LIFO method. But it's different for their international companies. They use FIFO. Okay. Again, the international reporting is a little bit different than the US reporting for GAAP. All right, so let's talk about this other thing that they can use. Usually assets are listed on the balance sheet at their cost, at their historical cost, what the company literally paid for them, right? Including shipping and all the other stuff as we learned from chapter 5. Well, what if something terrible happens to the value of that inventory over time? Um, you know, is it really worth what they say it's worth? Because you cannot, under any circumstances, claim to have assets that are more valuable than what they are. Because one of the principles that are that guides GAAP is something called conservatism. We have to make sure that we are never overstating certain things. We're being conservative with our numbers as to represent the best numbers that we know without overstating it, without exaggeration, without any of those types of things. So sometimes inventory declines. Right? Sometimes inventory, the value of inventory literally declines. And so basically speaking, companies need to what we call write down the decline of their inventory. They have to note that the inventory has declined. And so what they use is something called this lower of cost or market method to show whether they're actually using the real cost of the inventory, what it actually costs them to buy the goods, or because there's been a dramatic change in the price of that inventory over time. If they bought it today, it would be a radically different amount. They would pay what's called a market value, what the market value is. So they simply pick the lower of those two numbers to value the inventory that they bought. That's it. They simply look at the two numbers. The lower one is the value of the inventory. So here's how it works. Assume that we have this company, Kentucky TV, y'all, come on down. And they have the following inventory in stock. They got some of them there, flat screen TVs. They have 100 of them in the store. Their cost when they actually bought them was $600. But since the time that they purchased these units, the actual replacement cost, or what they call the market, has shifted downward to $550. And so when you look at being conservative with your value of the inventory for flat screen TVs, you pick the lower of cost or market. That's how the system works. And as you see, the lower is the $550, which is why it's in red. So the value of the TVs literally should be recorded at the lower of those two. 55,000 is the value of the inventory of those televisions. Okay. We got some of them there, satellite radios. So we got 500 of them. We paid $90 for them. That's our cost per unit. If we went out and bought them again today, we pay $104. So basically speaking here, the cost of $90 is lower, right, than the market value. So the value they will use for the radios on their balance sheet would be the $90 times the 500 units, so $45,000 of televisions. They got some Blu-ray players. Again, cost is $50. If they bought them again today, when they make up their reports, it would be $48. They're going to use the lower of the two to be conservative in their value of their inventory. And they got lots of CDs, 3,000 of them. $5 was their cost, $6 to replace them. This is not accurate, obviously. CDs are definitely on the way out. And so 15,000 would be the conservative estimate of the value of the inventory. So their total inventory value would be $155,800. Okay, different than if they use simply the cost. And this is because they want to make sure that they are using conservative numbers on their balance sheet. They're not overstating the value of the inventory. That's that. Okay. So here's a do it exercise based on the lower of cost or market. That's LCM, lower of cost or market. And again, you're simply picking the lower of the cost or the market for each level of inventory. In this case, this company sells home heating stoves, gas, wood, and pellet. You would simply pick the lower of the two. So obviously the 79 is lower, so you'd use that to value your gas stove inventory. 250 is lower, so you'd use that to value your wood. And 101 is the lower number here. So that's the value of your inventory. You simply would add those up to determine the value of the total value of their inventory for this company. And so it's $430,000 would be the number they would use on their balance sheet for the value of inventory. They would note they used the lower of cost or market to get to that number. Okay, that's how and they have to disclose that in the notes, in the financial statements. This is the method we used to get the value of our inventory. So like I said, nothing much to worry about here. This is quite simple. All you need to remember is you're just simply picking the lower value for each type of inventory that's listed for a company and adding them up. Piece of cake. So the last thing here is financial analysis, financial ratios. In inventory, there are two. Well, there's actually one with a further in-depth look at that one. And it's important to know because for these businesses, these retailers, their entire existence is based on selling inventory. So they want to make sure that they're selling a lot of inventory and they keep track of how many times they have to restock their shelves basically because they're selling out of inventory. And they do that on a yearly basis. And so we're going to be looking at how they calculate that. It's actually not a difficult thing to do, as you'll see, but it's an interesting piece of data, okay, as you'll see. Uh, if you're really good at inventory management, you have high hopes in this type of sector because this is one of the biggest problems that they have, is making sure you have just the right amount of inventory to sell. Because again, your whole existence is based on selling inventory, right? So if you have too much inventory, right? Um, well, it's not moving off the shelves. You're not selling it. And that's the whole purpose of having it, is to sell it. So that leads to higher costs for storage. If you bought this on account, you might need to delay payment of that, which means you'd have interest costs associated with that. And plus things go bad. They become obsolescent, right? Obsolete, in technology, and there's tastes that shift for fashion. And so if you have too much of that inventory and it's not up to date or in line with what's happening right now, it loses your chance of selling it goes down, right? Particularly at the price you wanted to sell it at. And I know you've all been to stores, and like myself, when I go to Macy's, and the very first thing I do is I go to the clearance section because I want to see, basically what's there first. And oftentimes they're not the same. Obviously, the clearance section, they're selling something for $20 that they wanted to sell for $80, right? So clearly, the revenue is impacted quite a bit with too much levels of inventory. But their cost doesn't change. Whether they sell that sweater at $80 or $20, they still paid something for it. That doesn't change. That doesn't change. What's changing is the amount of revenue that's coming in to cover those costs when they put something down. So high inventory levels um, can lead in some cases to big discounts, which means you're not making any money on the product. On the other hand, you never want to walk into a store and see nothing on the shelf, or they're out of something that they've claimed to have in stock. You walk in there, they don't have it. This happens quite a bit. It's a very sad situation. You leave, the customer leaves frustrated as all hell because they went in there specifically to get something. And for the company, of course, there's no revenue. When a customer leaves without buying a product they wanted, you lost the sale. You lost a sale, which is money and profit going out the door. And so that can't happen either. And so it becomes a critical task to manage your inventory well. So one of the things that they look at is how quickly is inventory selling out. So that's called the inventory turnover ratio. And it's a very simple ratio. It's the cost of the goods sold. And you divide by what's called an average inventory, which is your beginning inventory plus your ending inventory added together. That's your average. Okay. So this gives you a number of times per year that you're selling out your store, you're restocking. Once you know that number, you can convert that into an actual number of days. So simply put the ratio below 365. And that gives you a specific number of days in which you are moving your inventory. So let's see how this works. This is the data for Walmart. 2014 is really the focus here. Here they have beginning and ending inventory. So again, the ending inventory for 2013 is the beginning inventory for 2014. And so that's why they give you the inventory for 2013 here. The ending inventory for this year is the beginning inventory for the next. And as you see, the inventory turnover ratio has cost of goods sold listed first, 358, 069, and they need to average beginning and ending inventory. And when Walmart does that, it comes out to 8.1 times. Now, this is an interesting factor because what does this mean? Well, I want you to think literally, you know how big a Walmart is because you've all been to one, I'm sure, at one point in time. Imagine that they're selling out everything in the store and needing to restock it 8 times a year, because technically that's how you can view inventory turnover. Okay, just on an imaginary basis. So they're literally selling out their store over 8 times a year. That's how quickly the inventory turns over in that store. It's how quickly they sell their inventory. When you divide the 8.1 over the 365 days in a year, that means that Walmart literally sells out their store every 45 days. So this tells you how rapid things are going. Now, and this is for 2014. If you look at Target for the same year, okay, Target has a 6.1 time inventory turnover, which means they're selling out their store roughly 6 times a year. Okay, 6 times a year. If you divide that by, if you put that under 365, you're basically saying that Target is selling out their store roughly every 60 days, if you round that. So basically every 2 months, Target, sells out all their inventory. The industry here, very large retailers, are basically on a tear. Right? They sell out their store more than 8 times a year. Their store is sold out almost every 44 days. So clearly, large department stores that sell all types of goods from clothes and shoes to foods and personal care products and so forth. They're in a hot business. They have lots and lots of inventory to manage, and so this is basically uh, one of the more important issues that they look at is inventory management. Okay, we're going to go right to the do it exercise because we've basically finished our part of the chapter that we're looking at. And again, it's the same. It's just looking at the ratios that we just learned. So here we have Westmoreland Company. They switched to something called a just-in-time inventory system, which means they don't want to have a lot of inventory in the back room. They will order inventory quickly, and their distributors will get those products to them quickly, just in time for sales. Sales, cost of goods sold, and inventory data is provided for 16 and 17. So again, 2016 is listed here. 2017 is listed here. Now, although they give us sales revenue, we don't need this number. It's not part of the formula, right? The formula is cost of goods sold divided by average inventory, which is beginning plus ending divided by 2, right? So when you look at the formula for 2016, you'll see that it's $1 million of cost of goods sold divided by the average inventory, which comes out to 250, which is 4 times per year. You divide that over 365, underneath 365, and basically they were selling out their store every 91 days. When you look at the 2017 numbers, their cost of goods sold is lower, but so is their average inventory. And so their average inventory divided by that would give you 7 times per year. That's a much higher rate than 4 times per year, which means they're selling their store out much, much faster every 52 days. So if I were a business, I'd rather be selling out my inventory every 52 days than every 91 days, because this is more sales. The more inventory I can put on the shelf, the more it sells. I'm going to make a lot more money, a lot more profitability with 7 times a year turnover versus 4. Even though, again, the sales revenue looked higher in 2016, I bet they were more profitable in 2017, even though the sales went down a bit. But a lot of other stuff, I think, worked out pretty well. So those are the remaining 2 parts of chapter 6 that I wanted to review with you. And as you see, it's not real heavy duty type of thing, right? And in the first part, lower of cost of market, you're simply picking the lower of 2 numbers. I doubt you'll need help with that very much and adding them up. And then the financial analysis, what inventory turnover means and why they keep track of it. And then the number of days. Once you get that number, you can convert it to a number of days to tell you how quickly the store is selling out. So any questions?